Hello and welcome to our conversation on financial reporting and measurement. In this presentation, we'll focus on the measurement of assets with a focus on Ind AS 16 and a part of Ind AS 36. As a result, the exercise that we are going to do will have a bit of depreciation, impairment, recoverable value. So this is the information given just to drive in the importance of the application of Ind AS 2, that is inventory, Ind AS 16, that is property, plant, equipment, and Ind AS 36, that is impairment. I've taken a small exercise with where there is an opening stock, purchases during the period, a part of it sold so that we will have the application opportunity to apply Ind AS 2, and also the plant purchase and the relevant depreciation with an information on the recoverable value, which will give us an opportunity to apply Ind AS 16 and Ind AS 36. The focus is not to explain and get into the details of these three standards, but apply those standards in this context. So this is an ongoing business. So there is an opening balance sheet, and there is the plant is already there, plant one. Since the company uses depreciation straight line method, the plant is having an accumulated depreciation of 200,000. Therefore, that means the plant is about 2 years old because the depreciation per year will be 100,000. Now let us start working on it. So the company is having an opening stock of 1,000 units and purchased during the month of May 600 units at the rate of 480 and sold 25% of the stock for 500. So let us first handle this, and for that we'll apply the Ind AS 2. And so opening stock 1,000 units. This is a working note which will help us to find the cost of goods purchased plus and cost of goods sold and cost of goods unsold. Since no information is given about the methods of inventory valuation, for this exercise, we are going to use weighted average cost method. So the company purchased 600 units at the rate of 480 for cash. So the company has purchased goods and paid money, that is 288,000. As a result, since the stock has not been sold, so we will have the stock to the extent of increase to the extent of the purchase. We can see that the purchase of stock is 288, opening stock plus purchases minus the cost of goods sold. We have not yet sold the stock. Therefore, it is 688,000. Now, the company sells 25% of the stock. So 25% of the stock available is 400, and the sales is for 500,000. The goods sold for 500,000. And whenever there is a sale, we have to ask a question to ourselves, that is for cash or credit. And here it is very clearly mentioned, it is for cash. But more important is the concept of the cost of goods sold to be applied because of the matching principle. As I already mentioned, our assumption is to use weighted average cost. So the inventory, the cost of goods sold will be determined by finding the weighted average cost. The weighted average cost is equal to P1 Q into Q1, P2 into Q2 divided by Q1 plus Q2. So 430. So the cost of goods sold is equal to 430 into 400, so 172,000. So the value of inventory sold, the goods sold is for 172,000, and the cost of unsold stock is 516,000. Its cost. But there is no information about the net realizable value of the inventory. So our assumption will be the net realizable value is same as the cost value. Therefore, there is no inventory write down in this example. There is no inventory. Now the company purchased plant 2 on credit. The plant 2 purchase on credit. So acquisition of asset resulted in creation of a liability. Acquisition of asset resulted in creation of liability. And at the end of the year, the company charges depreciation 20% SLM on both the assets. So depreciation on plant 1 is 20% of the original cost, where the company follows SLM. The depreciation in year 1, that in this year, depreciation for the period is 100,000. But depreciation for the period is equal to 100,000. But depreciation up to the period, which is accumulated depreciation, is 300,000. 200,000 opening accumulated depreciation plus the depreciation for the period. And during this period, the company did not sell that asset. So the value of the asset, the original cost of the asset, stays intact. Now we'll charge depreciation. Before we go to the depreciation plant 2, we should also find out, as per Ind AS 36, the possibility of impairment, which is called impairment test. Impairment test is comparing the carrying value. The carrying value is equal to 500,000 minus accumulated depreciation. Compare that with the recoverable value. For this exercise, the recoverable value is already given. So there is an impairment loss. Ind AS 36 says if the recoverable value is lower than the carrying value, the value of the plant should be reduced to that extent, and the impairment loss should be shown as a loss in the income statement. Should be shown in the income statement. And to that extent, the value of the plant should be reduced. We can see that accumulated depreciation 300,000, impairment 25,000, original cost 500,000. So the net value of the asset by the end of the year is equal to recoverable value. In this case, it is a recoverable value. And now we'll go to, and this impairment loss is as per Ind AS 36. This depreciation is as per Ind AS 16. Then we'll see the depreciation on plant 2. Depreciation on plant 2, again, we are assuming 20% on the original cost, So therefore, depreciation will reduce the value of the asset to that extent. at the end of the year, the carrying value of plant 2 is cost minus the depreciation. Cost minus depreciation. So we have, till now, we have used Ind AS 2 for inventory, Ind AS 16 for a plant depreciation, and Ind AS 36 for impairment loss. The other expenses which are there is a salary. The salary is paid 75,000. We assume that salary has been paid, okay, and no liability to that extent. Then there is interest here, okay, so interest, because there is a loan as per the matching principle and the accrual principle, you're bound to show the interest for the period. Whether paid or not, you're bound to show expense. Here, because we have sufficient cash, we are showing we have decided to make the payment, even if the information given is silent on that. Once we have all the expenses, COGS, depreciation on plant 1, impairment on plant 1, depreciation on plant 2, salary and interest, we'll calculate the expenses. Expenses, income minus expenses, income minus expenses will give us the profit before tax. Unless specifically mentioned, we'll always assume that there is a tax of corporate tax of 25%, and the tax will be calculated on, okay, the PBT for the time being. And since we have sufficient cash, we'll also make the payment of tax instead of creating a liability in. And PBT minus tax is PAT. And PAT is a money belongs to the shareholder. Therefore, PAT will be transferred to the statement of changes in equity, to the statement of changes in equity. So our income statement is done. Incomes, that is sales, minus expenses is PBT. PBT minus tax is PAT. Let us find cash in hand. Cash in hand is equal to cash available minus the cash payments minus the cash payment is equal to cash available. Closing cash in hand, and closing cash in hand is an asset, will be transferred to the balance sheet. So we can see that the profit belongs to the shareholder. Profit belongs to the shareholder. So it is transferred to the statement of changes in equity. As a result, the other equity of the company increases to the extent of 51,000. Since there is no dividend, the other equity will increase to that extent. And other equity is a part of equity of the company. No change in the capital because the company did not issue any shares. So opening capital is same as the closing capital. And no change during this period, the company did not pay off this loan, nor did it take any new loan. So therefore, the loan will continue to appear on the balance sheet, and the total assets, total sources is 16,26,000. No change in the debtors. No change in the debtors. As a result, our balance sheet should tally, and that is 16,26,000. And the balance sheet tallies because we know A is equal to S or A is equal to E plus L, or because of the dual aspect concept, which is fundamental accounting principle. But at the same time, let us also observe the equity of the company. The equity of the company is capital plus other equity increased from 12 lakh 25,000 to 12 lakh 76,000. The number of shares is 50,000, which is capital divided by the face value of the share. And that will give us an interesting number called book value per share. The book value per share is also called equity per share. That is the equity available per share after meeting all liabilities. So equity per share has increased from 24.5 to 25.5 because other equity has increased. And other equity has increased because of the PAT. PAT is positive because the incomes are more than the expenses. So in the process, we are also able to see the interrelationship and interconnection between the financial statement. But the focus of this session was on this impairment, on the impairment, depreciation, and impairment. Depreciation and impairment. So impairment has happened here because the carrying value is greater than, the recoverable value is less than the carrying value. The reduction is called impairment loss. And here we have followed a model called cost model. This model is called cost model, where the plant is shown at cost minus depreciation minus impairment, if any, if the recoverable value is less than the cost value. But suppose in the cost model, if the recoverable value would have been higher, then the cost model says you cannot recognize the revaluation gains. The gain, because of the carrying value, recoverable value to be higher, cannot be shown. We can just see that. For example, the recoverable value is now 220,000. If 220,000, there is no impairment loss. And if there is no impairment loss, and in fact there is a gain, but because we are following cost model, it says you cannot show that gain, so there is no impairment loss. As a result, the gain, if any, is not recognized, maybe because of the conservative principle. So if you see in a cost model, the recoverable value is compared with the carrying value. If the recoverable value is greater than the carrying value, there will be no impairment loss to be shown in the income statement. And there is no impairment gains to be shown also. Okay. So the revaluation gains, the gains are not recorded. Gain not recognized. Not recognized. That's a better word. Not recognized. Whereas the loss, if any, is recognized. You see, this loss is 25,000. Here there is a gain, but still the gain is not shown in the income statement, and the plant will continue to appear at the cost, not at the recoverable value. So the cost model in this exercise, in this presentation, we observed the application of Ind AS 2, Ind AS 16, and Ind AS 36. In the process, we touched upon few important things, that is cost of goods sold, which is as per Ind AS 2, depreciation as per Ind AS 16, impairment as per Ind AS 36. So this exercise gave us an opportunity to apply the three important accounting standards. They all deal with the treatment, the measurement of assets, the measurement of inventory, the measurement of property, plant, equipment. Okay, property. And Ind AS 2 affects cost of goods sold. Ind AS 16 affects depreciation. Ind AS 36 affects the calculation of impairment. And interestingly, all these three items have a huge impact in the determination of profit. So profit depends on the methods of measurement of the assets. So profit is subject to accounting assumptions. Profit is subject to. So whenever we observe profit of a company, you should always examine the corresponding measurement principles. Thank you very much.